All right, let's talk about a really powerful concept in business strategy, the sustainable growth rate, or SGR for short. If you've ever asked yourself how a company can keep growing without completely running out of cash, well, this is the explainer for you. I know what you're thinking. How can a company possibly grow too fast? Isn't more growth always better? Well, not really. Growing too quickly can seriously strain a company's resources, sometimes to the breaking point. So there's got to be a sweet spot, right? And that's exactly where the sustainable growth rate comes in. The easiest way to think about it is like a financial speed limit for a company. It's the absolute fastest a business can grow using only the money it makes on its own. We're talking no new bank loans, no selling more shares to investors. It's pure self-funded growth. So to figure out this speed limit, we first need to understand the power of the company's engine. And in the world of finance, that engine is measured by a little something called return on equity. Return on equity, or ROE, is one of those key metrics you'll see everywhere. It answers a really simple but really important question. For every dollar that the owners have invested in the business, how much profit is that business spitting out? A higher ROE means you've got a more efficient, more powerful profit engine. And figuring it out is actually super straightforward. Let's use an example. You find the company's net income, that's the profit after all the bills are paid. In this case, it's $200,000. Then you divide that by the shareholder's equity. Here, that's $1 million. And boom, $200,000 divided by $1 million gives you 20%. That means this company is generating 20 cents in profit for every single dollar of equity. Not bad. All right, so we've got this profit engine running at 20%. Awesome. But now the company has a big decision to make. What do we do with all that profit? And this brings us to the second piece of our puzzle, the choice between paying it out or plowing it right back into the business. So one path they can take is to share the wealth, right? Give some of that profit back to the owners, the shareholders, as a cash reward. We call that a dividend. And the dividend payout ratio tells us exactly what chunk of the profit is being handed out. So looking at our company here, they paid out $50,000 in dividends from their total $200,000 profit. To get the ratio, you just divide the dividends by the net income. 50 grand divided by 200 grand gives us a payout ratio of 25%. Simple as that. Okay, so if a quarter of the profit is going out the door to shareholders, what about the other 75%? Well, that's where the retention ratio comes in. It's sometimes called the plowback ratio, and it's the percentage of profit the company actually keeps to reinvest in itself, for new projects, better equipment, expansion. This is the fuel for future growth. And this one is the easiest calculation of all. You just take 100%, or just the number 1, and subtract that dividend payout ratio we just found. So 1 minus 0.25 leaves us with 0.75. In other words, a 75% retention ratio. The company is keeping 75% of its profits to grow. So here's the key takeaway, and it's super important to get this. These two ratios are basically opposites. They're two sides of the exact same coin, and they will always add up to 100%. The more you pay out, the less you have to keep and reinvest. It's a fundamental trade-off. And this chart just makes it crystal clear. Think of all the profit as one big pie. A quarter of it, that 25% slice, gets paid out as dividends. The rest of it, that big 75% piece, stays in-house to fuel more growth. Okay, the moment of truth. We have our two key ingredients. We've got the power of the profit engine, our OOE, and we've got the fuel we're putting back into it, our retention ratio. Let's put them together and calculate the SGR. And you know what? The formula is so simple, it's beautiful. Your sustainable growth rate is just your return on equity multiplied by your retention ratio. That's it. It connects how profitable you are directly to how fast you can grow. So let's plug in our numbers. First, we have our 20% ROE, and we multiply that by our 75% retention ratio. And what do we get? 15%. And there you have it. That is this company's sustainable growth rate. 15% is its financial speed limit, the fastest it can grow on its own dime. Okay, cool. We did the math, we got a number, 15%. But so what? Why does this number actually matter in the real world? Well, this is where SGR goes from being a formula in a textbook to a seriously useful tool. Well, it matters to a lot of different people. If you're an investor, it tells you if a company's growth is real and sustainable, or if it's just being propped up by a mountain of risky debt. If you're a manager, It helps you set growth targets that are actually, achievable. And for you, as a student, it's the perfect link between profitability, that ROE we talked about, and a company's true growth potential. And this is how you use it in practice. Let's say a company is only growing at 10%. Well, that's less than its SGR of 15%. That means it's got gas left in the tank. It has room to grow without needing outside cash. But what if it's trying to grow at 20%? Whoa, that's faster than its SGR. That's a huge red flag. It means the company is going to be scrambling for money, either by taking on debt or selling off more of the company. So let me leave you with this final thought experiment. We know our company's sustainable speed limit is a solid 15%. But what happens if the CEO gets on a conference call and announces this super ambitious new target? We're going to grow by 25% next year. Well, that's a 10% gap. Where's that money going to come from? And that question right there is why the SGR is such a core concept in financial strategy.